So I'm Jared Paul. Most recently, I started a company called Scalar, Partner Scalar Analytics. It's a valuation services firm. Sold that to the management team. And now I'm the founder of a company called CapShare. We just raised $1 million, close on $1 million round, led by Kickstarter here locally and Draper Associates out of the Bay. So Tim Draper's personal line. And before that, I worked at Signal Peak Ventures as a principal for 5 years. And before that, I went to Harvard Business School, and I'm a BYU alum.
Can everybody hear me? My name is Brandon Rodman, the CEO and founder of a company called UVEF. My background's more in sales and design. Spent 6 years doing summer sales. If any of you guys have done that before, or if you guys haven't heard of that, I don't know where you've been. But 6 years ago, started UVEF with my co-founder, my brother, who's back there, Jared. And I pivoted about 3 years ago to providing a communication platform for dental offices that combines texting, email, and VoIP telephone service. We recently went through Y Combinator earlier this year. We've raised a total of $6 million from venture capitalists this year, and yeah, things are going good.
My name is Ken Davis. I'm the CEO of TaskEasy. My background is cybersecurity. I was the tech founder for a company called Oakley Networks that I think some people saw Brent Hawkins and a couple of others in here that are familiar with that company. Sold to Raytheon in 2007, where I was an exec for them for a while, long enough, and needed to come out and do another startup. So I went from cybersecurity to mowing lawns, lots and lots of lawns. So TaskEasy is a company that does services automation.
So Justin Jory, I'm currently operating my own fund called Horizon View Capital. My background is on the investor side and the valuation side. So I began my career, got a JD MBA from BYU, began my career at Pelion Venture Partners, then went to New York and did investment banking, advising large-scale buyout firms like Blackstone, Bain, TPG, all those giant firms on their acquisitions. Came back here and ended up working with Jaron, Paul, and worked with Jaron to build Scalar Analytics. And did that for a little while before Leucadia came calling. Leucadia is the biggest investment firm in Salt Lake City that no one's ever heard of. It had $9 billion in assets. No one knows they're even here usually, but they had $1 billion in cash, and they wanted me to come help them do a $1 billion plus acquisition. And I said, sure. So we did a few deals there, did a $1.5 billion acquisition, a $400 million investment, and then the $4 billion stock merger with Jefferies, the investment bank. They ended up, in the wake of the Jefferies deal, they ended up moving their operations to New York. And so I spent the last year and a half with Mercado Partners, which is a growth equity fund. So I guess my investment experience has been kind of interesting in that I've been in early stage venture, I've been in mature late stage buyouts, and I've also been in the middle stack, the growth equity space, which is kind of the gray area in between the early stage venture capital world that talks about multiples of revenue and the mature late stage buyout world, which talks about multiples of EBITDA. So that's my experience.
Okay, thanks. So let's start with this. So Justin, you were recently at Mercado, right? So at Mercado, what are some of the things that entrepreneurs would say when trying to build valuations that you kind of just laugh at and you thought we're just not smart?
Yeah, I mean, my favorite experience was actually at Pelion Venture Partners to share there. This was back in like 05, 06 or something, back in the day, and the whole kiosk thing was kind of new, and these guys were coming to pitch a kiosk photo printing play, and they had this agreement with Walmart, and they were starting to scale it out, but I mean, it was still like it was still beta mode for this company. And we were in the room with Blake Moderzitsky and Carl Ledbetter, and the CEO's pitching us, and everyone was like leaning in and nodding and like interested. This could be kind of interesting deal, you know. You could see I could scale it real quick and great margins, and wow, this, you know, I could see all the partners leaning in. And at the very end, the entrepreneur made the fatal flaw, right? The partners asked him, well, what are you thinking in terms of valuation? And he committed the grossest of sins and errors right, that entrepreneurs can ever do is he actually said something. He answered the question. Don't answer the question, okay? Unless you're Dave Bateman, don't answer the question, all right? He said, oh, 300 million. And everyone was like, like the partners were like trying not to laugh out loud because it was laughable. And they were just like, okay, well, it was great meeting you, and, yeah, we'll be in touch. They walked out the door, waited till the door closed, and everyone laughed. Like, that's hilarious. Never even called the guy. I mean, probably called the guy back and said we're not interested. But that's the quickest way to kill your deal. The right answer is we're going to let the market price the deal. So make us an offer.
Pelion just asked me that question last night.
What did you say?
This is why we have these two
said
on
it's up
here.
to
Let
them.
me intercede.
There you go. Good
Really
answer.
good contrast.
Oh, very well done. Very well done.
Okay, so Brandon, why don't you talk about when you are trying to build a larger valuation, what are the things you should be saying when pitching to a venture capitalist? You've raised $6 million. That's all been outside of Utah, right?
Yeah, it has. So the first thing, prior to Y Combinator, I was of the mindset, get the highest valuation you possibly can, and I'm complete opposite now. Getting a really high valuation, you want to get something that's fair market value for your company, but you don't want to get something that puts additional stress and pressure on your company to grow at ridiculous rates. There's a lot of companies that do that. You hear about all those companies raising tons of money nowadays, and you get kind of envious of them. Like, they only gave up what percentage of their company? And in the long run, if you really build a successful company, it doesn't matter. But there's a lot of things that go into raising money, and all of this really comes from my education at Y Combinator about how to raise money, and then screwing up after learning from them how to do it, and then realizing, okay, maybe they're right. So my experience is that just about every VC is going to ask you who you're talking with. Your answer is just about everyone. Like, if you know who they are, we're talking to them. But you never tell them who you're talking with. I actually just talked with someone recently who was meeting with two different firms. Both the firms said they were interested, and one of the firms said, we're really interested. Another firm was asking, so who are you meeting with? And he's like, I'm not going to tell you. They dug a little bit deeper, and he finally told them who he was meeting with. Well, one of the VCs called the other VC, said, are you guys interested in this deal? And the VC that he thought was interested said, no, we're not doing it, and made the entrepreneur look like an idiot, because he thought that they were interested. So you just set yourself up. Even if you have a really good group that's interested, still don't mention their name. The other thing, Jordy, right? Jory, sorry.
Or Justin,
Or
either
Justin, okay. What he mentioned is don't tell the valuation, let them come up with it. And they're going to dig, I've felt like an idiot. My brother's been in some of those meetings where they're like, really, you're not going to tell us? Like, at least give us a ballpark. And you're like, no. And then they dig even further. And, I mean, all the VCs we've met with have really been good people. It's not like they're being mean or they're being jerks. But they're trying to find out. They want to be competitive if they want to be on the deal. But they also want to know the way that you think. And so, anyway, sorry, I just talked for a lot.
Oh, that's great.
There, so. I think so you can't lie, you can't make stuff up. It's like a sales presentation. You need to present it the right way. It's not what you say, it's how you say it. But they're going to be left with information, so they're going to look at growth numbers. They're going to be interested if they're interested. I don't think you can force it. Every firm has their own thesis. They've gotten money from their investors to invest in certain types of companies that fit a certain mold, and they'll very rarely go outside of that mold. When they dig, the first couple times you're probably going to do a really bad job at it, and you just got to keep doing it. And eventually, you might sound like you know what you're talking about. When they ask those questions, you're like, you know what? I don't meet with 10 companies every single week or every single day. I just know that this is the revenue we've been doing. This is how much we raised at last round. And the most important thing for us is to find a good partner, and the valuation secondary to that, and just leave it in their court. Like, it's your job to decide how much you want you think this company's worth. So.
We just got that on video, so you can see that later. That was good stuff. Okay, so Ken, tell me, what do you think of slide decks? So I'm an entrepreneur going into pitch. What are your thoughts?
Well, I mean, so I think you should have one with you and then probably not use it. So you got to know your information. You got to know the firm you're meeting with, the investor you're meeting with. They've done deals before, so it's pretty easy to look up what what they like, what they don't like in the marketplace, what size of deals they're looking for. Do they reinvest in round B and round C, so you kind of know how much dry powder they're keeping on the sideline to keep investing in you down the road. And actually, all these things, it's not so much that you're not talking about valuation, because it exists. It's a real thing. I think you can actually, just doing some good research, figure out what your company's worth, and everybody will kind of have that feel. And so, I'm not quite so strongly opposed to talking about the number. I think it's helpful for it to be a real thing. But you got to talk intelligently about it. You can't just you can't just throw out a 300 million pre-money value and hope that people are going to take you credibly, because they won't. They really won't. And they're going to look at your revenue, and they've got a formula, and they're going to look at your growth rate and the industry you're in and a bunch of other things, and you need to know that stuff as well as they do. Otherwise, you can't talk about it. So slide deck. I've gone back and forth over the years. I've done some really complicated technology demos in my lifetime. That's what I got guys in the back of the room here that have watched me do tech demos for 15 years. Using modems, dialing up from Bogota, Colombia. Trying to get internet security stuff to work. It was really a tough demos. And in general, I think you got to be able to present your company and your product better than anybody else out there. And oftentimes that means that you don't just have one deck, you have 5, because you got to be nimble. You got to be able to present to your audience. I remember, I don't know if anybody was at Utah Tech Week, but the speech I gave at Utah Tech Week was not the speech I prepared. And that's because I watched the other speeches during the course of the event, and I'm thinking, hey, I've got to change this material up a little bit because the audience is different than I expected. And so, yeah, you got to have a slide deck, but you probably aren't going to use the one you came prepared to use.
Yeah. So say I'm raising money, and there's one venture capital firm involved in the deal. Why don't you take this one, Jaron?
Sure.
Well, they're involved in the deal, and I've got to I've got other ones interested. How do I tactfully handle that?
Yeah, and I can speak from just my experience in our most recent round. So, I had self-funded the company for at least 2 years before we raised our most recent round. And I had talked to Gavin at Kickstart a lot about potentially putting in a little bit of money so that I didn't have to keep funding it myself as much. I have a lot of skin in the game in my business, and so I was happy to kind of potentially share that. And so with Gavin, he threw out an original number and a valuation, and it was a convertible note. So he threw out a cap on a convertible note, which will become our valuation when the note converts in. And so we talked about that, came to a number, and crazy thing happened. 2 weeks, well, not quite 2 weeks, but maybe a month later, we got a call from a strategic investor who said, hey, we want to invest $600,000 into your business on a much higher valuation. And so I had that great awkward call with Gavin where I kind of said, hey, I know you wanted to invest this much, but literally a month later, someone came in and said, hey, we want to invest a significant up round to that. So would you be willing to kind of carve some of that back? We kind of met in the middle. And interestingly enough, I'm kind of on this whole discussing with other investors. Maybe it's my stage because we're a very seed stage company. But I didn't find it that difficult, honestly. I mean, I'm a little bit more of an open book. So, especially Gavin's an old friend of mine. We used to work together at Signal Peak. So I kind of had one inside investor that I could just pick up the phone and speak to like a friend and get advice from. So when we ended up reaching out to Tim Draper and met with Tim Draper in the Bay, I just kind of told them, hey, we've got a commitment here, this valuation. He kind of said, hey, I'd be willing to invest at a higher valuation. But to Brandon's point, we honestly didn't kind of try to play them off each other, or we didn't go back to Gavin and try to get his valuation up. Because I agree so much with what Brandon said. We care a lot more about the partners we have in the deal, whether they believe in us, whether they're going to be supportive. And frankly, I don't want to create that failure case of, hey, I just raised money at a $5 million valuation, a $10 million valuation, and we're going to turn in this year huge growth, but not anywhere near the numbers that would merit or justify a $10 million valuation. So the next time, if I need to go back out to the market to raise money, I'm going to be looking at a potential for a down round or something. I just think that's crazy and very short-sighted. So, in general, I tend to very strongly agree with Brandon's point around be realistic around your own valuations. I think it'll help you out in the long run.
Correct. Jaren's got experience with this too, but I would say normally think about that. IP is just a qualitative factor in the analysis of the company itself. So we really value the company as a whole. We don't go through and attribute a value to a patent and a value to the team and a value to the tech, and you really analyze the entire thing as a whole, right? And then the investors kind of go like this. There's your offer, right? So they'll take a stab at it. They'll look at the market. They'll look at the market multiples for the industry you're in. And really, that's it. They look at the market and say, does this company as a whole, IP, team, product, market, etc., deserve a premium or a discount to the market rate on revenues? And that's really it as far as early stage tech goes. If we want to talk about mature late stage buyout stuff, which maybe that's not this audience.
Take a turn.
I'll take a crack at it. So when I was an investor, and I've been an entrepreneur for a long time since, I think, and you'll find this a lot with Utah investors as well, there's kind of varying degrees of risk in different types of deals you might do. You might think, hey, venture as an asset class, venture capital as an asset class is extremely risky. That's true. But I would say that there are subsegments within venture, i.e. consumer type deals, which are even riskier. And so I focused on enterprise technology and SaaS companies. And so those typically, they can sometimes skyrocket and hockey stick like that, but they tend to be, in my opinion, just a little safer. Consumer trend businesses are very, very difficult to time and to get right. I would defer perhaps to Justin here, because Mercado invested in Skullcandy. They've invested in a good friend of mine who used to work with me at Signal Peak at VSpring at the time. A guy named Jeff Curl started a company called Stance Socks. They're a branded sock company that's just going crazy. I personally don't have the stomach for those kind of deals, but lots of people make a crazy amount of money in them, and they do incredibly well. And like you said, it's you just kind of hope that the markets don't correct, or that the trend or fad doesn't go the wrong way while you're an investor in the deal. And I think part of timing that and thinking about, hey, is this likely to go away while I'm investing in it is one of the key questions you're going to probably ask.
So then, Justin, say currently you're looking at Uber, and you see a $1 billion raise 1 year ago and $20 billion valuation a year later. Does that not raise all kinds of red flags? Do you see it as toxic, or are you thinking we got to jump on this before it gets to $100 billion?
It depends on your outlook on the business and the industry they're in. That just sounds like insanity to me. But this is the thing. Uber, right? What's the size of the target market? It's massive. It's massive. So yeah, if you think this thing's catching on, it's not going away anytime soon, then jump on the train. But the fit from an investor perspective depends on so many factors: check size, industry. So what you have going on right now, you have kind of a strange phenomenon where if you look at like Domo's recent raise, I don't know if anyone paid attention to who one of the lead investors was in their latest round. It was Fidelity, right? I think it was. Or no, was it T. Rowe Price? I can't remember. It was a boring mutual fund. It's like, what? A mutual fund is leading Domo's latest round? Right? So what you have going on is public investors, those mutual funds, are realizing there's not a lot of return in the public markets, and they recognize these deals have tons of potential and they have big funds and they're trying to find any advantage they can to get 2 percentage point yield advantage against their competitors. And so they're now dipping down in and doing these growth deals and just investing at lunatic multiples. You know, but you know what? When Kleiner Perkins invested in Google, people thought they were crazy. What? That ugly, bland site? Seriously? They invested at a $200 million valuation, right? Well, they crushed it. So, you know, yeah, who's to say Uber isn't going to be a $100 billion business? I don't know. You know, time will tell. For the Fav one, though, gosh, you guys cut me off, Ryan, if I go in too far here. The Fav one, though, I mean, just like Groupon, when Groupon got the $6 billion offer from Google and they didn't take it, I was like, oh no, what a mistake. What a mistake. Why? Their business has no barriers to entry. Okay, you'll hear investors and strategic-minded people talk about that, right? Fab.com, you know, the flash sales site, how easy is it to build one of those? It's not that hard. How easy is it to make a Groupon competitor? It's really not that hard. You know, and if you understand that Groupon essentially bought all of their sales. They didn't earn it. They acquired it, right? And so their actual organic growth wasn't very impressive over the life of that business. So anyway, yeah, you know, moats, trenches, barriers, whatever you want to call it, whatever makes your business unique and tough to replicate, that's what truly merits a real valuation. Now, what's going on with Uber is a thing called a network effect, right? It's what Facebook had that MySpace didn't have, right? MySpace was the leader first. You remember that back in the day? MySpace was cool, and what Facebook, you never heard of it. But then Facebook passed them and built the network. And so MySpace just died like that. So there's certain businesses like Uber which have a network effect, right? You want to be on that one network. There's not going to be a second. There's not going to be a third. Maybe there is, but I doubt it, right? There's one big network and everyone's going to get on it. And if you build that, that's a network effect. That's a big barrier, and it's a big competitive advantage. And if you build that, then that could be worth $20 billion.
That's good stuff. Thanks, Justin. So Brandon, let's direct it towards you. If I'm trying to work with investors and I'm giving them a hard deadline, tell me about that. How do they react to it? How do you build towards that deadline? Do you even believe in doing that? I've heard entrepreneurs do it lots of different ways.
So there's the golden rule. He who has the gold makes the rules. So I don't think you can put pressure on investors, but to just set a date and tell them they have to get back to you by then, I don't think that's going to work. I really haven't tried, but what do you guys think of that?
When I raised my search fund, which I have right now, I did that.
Okay.
I did that because I have had experiences where I've been talking to investors, and investors are funny, right? They're like sheep, right? They're going to follow the crowd, right? So if they believe the crowd is marching towards your business, then they will follow. They will go along too, right? And so I had the experience earlier on when I was trying to raise, I actually almost raised a search fund back in 2009, but I kept talking to all these investors, and they were like, yeah, I'm interested. And I was like, okay, so now what? They're like, yeah, let me think about it for another week, right? And the other, yeah, I'm interested. Yeah, call me back in 3 weeks. You know, and it just kept dragging on. I was like, man, what's going on here? And so this time I just said, hey, I'm closing this thing, and I've only got a few slots open. Do you want in? And they're like, oh, yeah, I'm in. Okay, cool. Here's the docs. Write a check. Closing in 2 weeks. They're like, okay, cool.
Yeah. So what he's saying is you want to get a lot of people interested in a short time period and use that as the deadline.
Create
like
scarcity.
You're going to miss out. There's other people interested, but you know, I haven't been somebody that said, hey, this is like a hard deadline. You need to tell me by then. And so
let's elaborate on that. How do I create urgency as an entrepreneur to get that investment? So what are the things I'm going to be saying?
Well, first, you're going to set up as many meetings as you possibly can in as short a time period as possible. So you create that just naturally by, you know, I meet with 50 investors in 1 week, and like you're going to have people interested, and then you can say, hey, like I've met with a few firms, you know, I'm not going to tell you who I've met with, but they're really interested, and things are progressing faster than I anticipated. We could have a term sheet any day. And I think that can create the leverage that you want, but you have to be careful. Like I mentioned earlier, don't tell them who you met with, because sometimes investors will, it's like their job to be interested and to wait out and to reduce the risk of their investment. And they're sheep too.
Yeah, and they're really clubby. So they are gonna call their buddies. And so I would just add an asterisk to your comment about 50 investors, that sometimes, if you're getting around too much, right, it's kind of like, ooh, I would be careful. I wouldn't go overboard on how many people you talk to, because then the investor's worried, like, oh my gosh, you're talking to so many people, like, do I even have a shot here? You know what I mean? So it depends on your stage and where you are, I think, a little bit. But if you are talking to everybody and everybody's hearing it and talking about it, then sometimes you'll attach a lower probability to the deal. From my own investor group, we'll be like, oh, wow, okay. Do we have a shot? They're talking to everybody.
Yeah. So for our round, we turned down investors that wanted to invest. And we just said, sorry, everything's taken. And it allowed us to be selective on who we wanted to take money from versus needing to accept money from whoever would give us money.
So one of the things I've learned is telling an investor no, but nothing drives them more nuts. It's a phenomenal feeling, right? But tell me about a non-deal roadshow. So if I'm going to go out, you talked about building urgency, you talked about getting them involved. Explain how that works.
Well, so for us, it was kind of unfair. Y Combinator just does that naturally. You have demo day coming up, and there's 500 investors. They're going to be in the room. If you ever need to talk to anybody that has money in the world, essentially, somebody at Y Combinator, through their network of investors, can somehow get you in contact with them. So it really was unfair for us because we couldn't raise money before Y Combinator. We got turned down by, I think, every VC in Utah, and didn't get outside of Utah. So we're in the process right now of doing a Series B, and it's obviously different because we don't have demo day. We don't have that time where there's 500 people watching us, and it's the fear of missing out that somebody else is going to jump in on the deal. And we've been a little bit more selective on who we've gone to, but still we've kind of pushed pretty hard, tried to meet with just enough where it kind of makes it's kind of confusing to keep things straight in my head of who I've heard back from, who I haven't heard back from yet, but enough that we can kind of keep things going. So
Ken, why don't you elaborate? You didn't have the demo day, right? You had to build that momentum over time. Tell me how you did that.
So I think, I like the notion of getting the word out. I'm not so sure that I would just talk to investors to get the word out. I think there are a lot of people that influence investors that aren't investors. And so it's important to, meeting with your big customers and creating some real hype around what's going on there, meeting with industry experts that might actually have some back talk to your investor community. That's probably every bit as important as actually meeting with real investors. I think another thing that I've noticed, talking about setting deadlines and those types of things, every entrepreneur has a deadline. It's the day they run out of money, frankly. And I go back and forth between trying to call an investor's bluff or have him call mine, and just being transparent with them. And I actually over the years have learned that transparency is actually a little better. And so I tend to describe what's the nature of the company. I try to explain the growth rate and the path it's on and create enough excitement and enthusiasm for the potential that it's really not a big deal that it's running out of money. It's part of the course of growing a business if you haven't passed that cash flow positive milestone yet. And so you can't always set a hard deadline, but everybody ultimately has that really tough one. One other thing I'd say is that you can oftentimes create a lot of kind of deadline urgency by demonstrating opportunities that will either exist or not exist with or without the investment. And I think that's what I like the most to talk about. So, in our deal, we're really truly doing services automation. We're making it so that when people click a button, services magically happen. And that's a very different experience than what people would get if they were to just try to use a lead gen site to get services performed, which there are so many out there. You guys all are familiar with them. But the way we created a lot of excitement and enthusiasm was around some of these really big opportunities that exist here. Like one thing we really focused in on was there are these massive single-family home aggregators that are buying up tens of thousands of properties. And we got a bunch of them to not only sign up as customers, but actually to make financial commitments toward the round. And so with their commitment toward the round, it was quite easy to go to institutional investors and say, hey, look, these guys that are actually going to pay us money in the form of revenue are also investing in the round, so why shouldn't you? And so that kind of sort of urgency and enthusiasm that's sort of deadline centric but not truly a deadline is what I think is the most important. Yeah, so there are all kinds of people that really can move the needle. Jody Shepard is one of them. Gavin Christensen is another one. And these are people that they're just really scrappy, really smart. They know what's going on in the community, and go get to know them. Take them to dinner and just sit down and actually be like a real friend. Like don't just try to constantly be selling people something, and that actually helps out a lot. I consider both Jody and Gavin to be really close friends, and they're terrific. They're helpful in every way. If Gavin needs me to be on a panel, I would do it in a heartbeat, just because it's helpful to him and growing his firm, and it's that kind of sort of quid pro quo and helping each other out that goes a long way. Jody Shepard at Square One Bank, this is the bank that's notoriously number 2 to SVB, to Silicon Valley Bank, and they're frankly being more scrappy than Silicon Valley Bank is right now. They're working harder for deals. They're beating terms soundly, and Jody's at the front of that. He's kind of over the Mountain West region, and so you get to know him, and of course he knows everybody in the venture capital community. So he makes leads, and when you have somebody that's known like him suddenly talking to other venture firms and saying, hey, you really need to talk to this TaskEasy company. They've got something kind of cool going on. It means a lot more than if you say it. And so think about that. Like really try to get out and get to know people that are helpful.
Use quota deck. Where's Bubba?
Bubba's not, I don't think he's here anymore.
Bubba,
Go ahead.
What about investing as a hobby? My GM seems to think that we have a company that's kind of unique, and he thinks we might be able to get someone to invest in our company a small amount just for hobby's sake, that they would like the idea and they want to be a part of it. Is that something you guys have experienced before, that investors?
They're called angels. Right? I mean, aren't
Yeah,
they?
he's exactly right.
Is
Yeah,
that legitimate that, people do
yeah,
that?
absolutely.
Okay,
Yeah.
it's not just wishing and hoping.
yeah.
I invest as a hobby. What you got for me?
I own a pro sports team here called the Salt Lake Lions. We're a professional ultimate disc team, and
You reached out to my assistant and we could do it.
Is that like? I have no idea what an ultimate disc is. All right, well, we're getting off topic.
Cool.
We're
If
getting
you
off topic.
look at the website, it's actually cool. Look at it later. But
All right,
anyway.
we're getting off topic.
Okay, so
We'll talk later, buddy.
Let's dig into this though. So let's talk about a company that's not tech for a second, if that's okay. And let's talk. Are you okay if we talk about how to value your business?
yeah, that sounds great.
Okay. So why don't we dig into it? Why don't you go ahead and just start asking the questions, and let's figure out the value of this business.
All right, let's do it.
What do you think the value is? No, I'm kidding.
Start by telling us.
Okay, I didn't ask, I intentionally didn't ask about entrepreneur. All right, go ahead.
I would say, what are you doing in terms of top line?
I don't even understand.
So revenue.
Your revenue. Oh yeah,
Okay.
it's okay. Just your revenue, annual revenue.
And you may not want to disclose some of this information in public.
Just multiply it times 10.
So
Make your actual number times 10.
Go ahead. Yeah. So what's your top line revenue?
We gave away a lot for free our first season, so not a lot.
Okay.
We're talking, we had about 30% of our people that came to the game were sales.
Okay.
So and the ticket prices were about $12.
$12.
So in the last 12 months, how much revenue has that been?
It's seasonal, so we made $10,000 the entire season.
Okay, perfect.
So if you're looking at that range of revenue, most investors are going to look at that and say that's not enough revenue for us to have
Which
to
is
be
why he's looking
convinced.
for a hobby guy, right?
Right. And that's great. There's nothing wrong with that. They're just going to put you in kind of the earliest of early stage startups. So you would kind of be in like a seed stage category, an unproven concept category. And so there, I think they would be looking for, hey, do I believe in the long-term growth? And they would actually have to do some kind of financial projections to project out your growth to come to some kind of an understanding of what that could be. So, if I were going to ask some additional questions, I would kind of say, what do you think you're going to do next year in terms of revenue? What do you think you could do 3 to 5 years out? And in fact, that's almost always how a venture capitalist is going to think, even if they don't explicitly say that. They're going to say,
like sponsorships and partnerships in
yes,
that number? Okay.
all of your revenue.
Because we basically did no monetary sponsorships the first year, right? And that was all like, people offering goods or services. We want to be community-based, right? But also, of course, make money. That's why I love it. So, right, we did that. And then this year, my focus is on sponsorships, building businesses around the company so that we can get even more people to the games. And I'm looking at, I think, a real number is 3 times the amount of attendance we had from last year, which I don't think is hard to do because we're changing some fundamental things. So, are those things I should be expressing to investors?
I think,
Yeah.
if you had no revenue, you'd be worth at least $50 million. But it's that $10,000 that kills you.
Now, hey, he just has to figure a way to get out of that. He can get into the money, but now he has to exit.
Yeah, so there's a few things you want to understand about investors when you talk to them, right? The question, here's some basic super vanilla questions. Are you a control investor or a minority investor? Okay, well, I'm just saying, you want to ask that investor, right? Because if he says, I'm a minority investor, so then you think, okay, so his check, and and then the next question is, what's your check size? And they'll say, my minimum check is $1 million. We won't do anything below $1 million. And so instantly you're like, okay, you're out. I need to talk to somebody else, right? Because you need half a million dollars, but apparel companies don't get the best valuations because they are lower margins. They're CapEx, they're inventory intensive. I won't say the word CapEx, but they're inventory, working capital intensive. You always need money to grow versus a software company where you just click a button to grow, right? Or actually you hire developers.
Is that how that works?
And you
Sell,
could
produce one more copy.
I know you feel like that's not your business. You could be defying those odds right now where you're under 500,000 and you're the owner that's willing it there. It's when you scale that it's hard to maintain those high margins. Okay, well, then you do it again.
Well, and Mercado has made a very successful, investing in consumer retail companies, Skull Candy and Stance as examples. And what they really look for is brand, right? Because brand is what creates sticky revenues, right? Brand is the same thing as, recurring revenues essentially in software. It's that stickiness factor where that revenue is going to keep coming back. And so, if your clothing or apparel company is mainly selling on Amazon and mainly selling at a lower price, most investors would shy away from that because there's no stickiness factor there. Your margins are going to erode quickly once competitors come in and catch on to the fad or the trend. And so, Skull Candy, right? They did a great job of preserving their brand. When they didn't preserve their brand is when they fell into hot water. You look up people who sold apparel companies. There you go. They've got money. They understand it.
Or you do kind of what Ken said, which is to find an influencer, find someone that may not, if you talk to, and I'm not familiar with Jody. I'm not familiar with
Jody Shepard is good, but yeah.
I know Gavin very well, longtime friend, and I would speak highly of him. You find someone, anyone really, that's in this kind of space, and they'll have an idea of who to talk to. They'll say, hey, I don't invest, I'm a technology investor. Going back to Justin's point of, investor groups have very specific targets of what they're looking for, but there are certainly people out there who would probably be interested in your business. And to Justin's point, like a Rick Alden, someone who started Skull Candy, he's very, very wealthy. I'm sure he makes a lot. In fact, I know he makes angel investments. And so, you'll talk to someone and they'll say, hey, well, have you thought about talking to this person? And then you spider out from that person. Yeah.
He invested in Outbox, by the way.
Oh, okay, great. So,
What was your question?
So I don't think it is, but I think, honestly, you always want to tell the truth. So if you really do have two investors, both coming in, and like just don't tell them who you're talking with, but you're telling the truth. So you can, if one of them falls through the cracks because you're trying to play them off each other, you still have something to fall back on. And you don't have the chance of them colluding together and then lowering the offer or anything like that. So is the general rule of thumb 18 to 24 months?
18 months.
Yeah, something like that. That's a rule of thumb. I think if you're growing fast enough, it really is contingent on how fast you grow. If you can grow really fast, and some companies it's a market grab, and the faster you grow, you can justify burning more money, but you usually don't want to, plan to burn a lot of money unless the growth justifies it. So
Enough time for a
Great
couple
question.
bumps in the road, but they can still produce something of value. That's the key, I think, as an investor. You want to give them enough time and enough money to goof around a little, right? Give them some elbow room, but enough time for them to actually create value so the next financing round, the business is worth more.
Your first question has a lot of variables. Ken, go ahead.
Yeah, I'd say that the timing question is really more about the types of money that are available in a market. And it's interesting because I've watched Utah go through, we raised money for my last company in 2004, and Utah was a bit rough back then to raise money, and especially we were trying to raise about 17 million. We ended up doing a round with Kleiner Perkins, and there was almost no way to get that kind of money pulled together in Utah at that moment in time. And then I would say there's been a period of about 2 years here in Utah where kind of between angel and A round, or maybe angel and B round, has been pretty hard pressed to find, like that kind of past the angel investment, but still needing enough money to really grow the company out. It's that pocket of money has been hard to find, right up until I think Kickstart, started being pretty aggressive in that very particular arena. And so you kind of have to just pay attention to those types of dynamics a little bit to know what you're, how much runway you should have in order to grow your company. If you know you need to get to a certain deal, you hear this all the time, like Sorensen and Mercado will both tell you if you're not doing a 4 to 5 million or even 5 to 10 million run rate in revenue, you're not going to get any money from them. And they just flat out, they'll tell you that in the first moment on the call. And so if you're banking on getting money from them and they're the only game in town right now, you better have enough runway to get there before you even knock on their door. So that's what I think. It's really about knowledge and just getting to know what's available in the community, what deal sizes people are doing, how tight is money at certain stages, and make sure you can leapfrog past those stages properly. That's kind of to your point. It might be 18 months, it might be 24 months. Even on the investor side, I think you have to pay attention to those deal dynamics too. And I've noticed the investors I like working with the most are the ones that are actually calling ahead. So they're already calling the people that are going to do my B round to ask them what the deal dynamics are going to need to look like in order for that B round to close or to work, if we need it. Like, let's say we get to a point where we need to raise a B or we want to raise a B. Like, where are we going to have to be? And that's so helpful. Any investor that can provide that type of credibility and lift is worth everything. These guys, there's a group in Colorado that did some really early money into Uber. And I really like them a lot. I think they do a great job at sort of timing those investments and making sure that they know that the new investment's going to be available.
But I kind of go back to the, you want to be a market maker as an entrepreneur, so in terms of the investors. So you want to actually go out and create multiple offers. That's how you're going to know what your valuation is. If you go get one offer, that valuation could be extremely low, or you might luck out and it could be extremely high, and you'll never know. But if you go get a couple of offers on the table, if you can do it, then a couple term sheets, then you'll have a much better sense of what your valuation is. So that's the best thing you can do.
Let's go back to Curtis and then Scott, and we'll come back over here.
I think it's important to, and this will be mean to anybody that you guys were associates in a firm, I don't know. But if you get inbound interest from an associate.
They were not associate.
As a principal.
They were
Okay.
A couple levels up.
Okay, there you go.
Give them some
Wasn't
love.
a partner.
But if you get
I'll correct
inbound
it
interest from an
since they did.
associate, you can kind of ignore that for the most part, because very few deals that VCs fund ever come from that. Usually it's from a referral of somebody that they know. If you have a partner reaching out to you, that's different.
Yeah. He's had managing directors.
Yeah, if you have managing directors and partners, then you just have to decide, are you raising money or not? Because if you're not raising money, tell them, we're not raising money, we're profitable, we're doing great. And like what Jaron said, that's just going to piss them off because they want to win.
Love it. Yep.
They think you're going to win. They want to give you money. They have to spend their money. And so you're just going to kind of stoke the fire. And then when you decide you want to raise money, you might have 10, 15 people you can go to really easy and say, hey, we decided we're going to raise money now. Are you still interested?
Take them to lunch, tell them you're awesome, and tell them no. And you'll always be in a great situation.
Was the second part of your question about whether you should raise growth capital or whether you should sell your business? Was that a question you asked?
Should we be spending our time? We've had managing partners and directors come fly out here to Utah to meet us from New York, all of that. And the question is, should we be pursuing that? We found some great partnerships with some of their portfolio companies, or should we be looking for buyers instead of talking to investors?
Well, that's a decision that's a decision for you guys. What I would recommend is generally the perfect time to sell your business, sell a majority or control of your business, is just before the peak, right? So if I was Lance Armstrong, right, I would have sold my enterprise right before the 7th race, right before the 7th Tour de France. I would have been like, I'm selling into the 7, okay? I'm going to get the 7th, right? I'm going to get it, so why don't you pay me 3 times for it, right? Because it's going to go 7, 8, 9, 10. It's never going to stop. I'm like, you're right. 6 in a row. It's crazy. Yeah, we're going to pay you for 10 wins. Oops, there's really only 7, right? You're like, that's what you want. That's when you want to sell your business. Now, that's funny advice because I'm right now trying to buy control of a business. And so, yeah, I'll believe you and I'll make the offer, but then in due diligence, I'm going to be poking around looking for skeletons in the closet. I'm like, all right, what lies have you told me? What are you not telling me? Right? So, anyway, hopefully that's helpful.
I think those are good answers. Anything else, Curtis? Okay. All right.
An option you could do, which you should think about, is you should do a growth round where you have some of it is secondary, where you sell 25% of your business, let's say. Half of that round actually is liquidity to you, the owners, and the other half is growth capital on your balance sheet. That's a great deal for you. That's the kind of deals Mercado does. It's the kind of deals that Sorensen will do. You guys are a growth equity candidate, and that's a perfect deal for you to do. Take some chips off the table. You can pay off your houses and do whatever, and get risky again with your business. Right now, I bet you guys are kind of pulling back a little bit, right? You're like, we built this really cool business, but we haven't sold it yet. Oh man, are we going to take risks anymore? I don't know. We don't want to, right? We don't want to risk what we've built so far.
No, we're in full growth phase. We're putting everything we can back into the business.
Pedal to the metal.
I'd love to hear your opinion because we've had 2 companies suggest what you just said, they call it, I think, a partner risk round or something like that. So
all right, and you and me, pot stickers in the back after this thing's over.
Okay, go ahead. Let's go to the next one. That comes down to you as an entrepreneur, managing your evaluation, managing the term sheet, understanding what you're getting into, and then raising at the right time. But there's an art form to that, because there are a lot of entrepreneurs that get caught up in taking venture capital money and end up in a bad situation. Yeah. I've talked to Paul Allen, the founder of Ancestry.com. If you talk to Paul, he'll tell you that's what happened. And caution entrepreneurs, because Ancestry.com is a behemoth, but what he ended up exiting from that was really minute compared to what he should have.
I will say I think control's a bit of a myth. So I think what helps you to have control over a company is you're running it and you're succeeding. And anything short of that really doesn't help you to maintain control, because the ultimate way to lose control is to run out of money and not have an investor at the right time. So I think I don't think people really should be that afraid of selling off a portion of their company to a good investor. It's really about, do you have the confidence to bet on yourself in a way? Like, do you believe you can actually take that investor along with you to success? And if you do, you should do it. If you don't, then you probably should rethink your strategy a little bit. That's what matters.
And the other side to that is if you get too fixated on that, there's lots of other ways you can lose control that have nothing to do with equity.
Yeah.
And I think also,
I would, sorry, Justin.
no, you got it.
I would add one other thing is, I mean, if it depends on the nature of your business. The business I owned before was a services business, and it was a venture capitalists investors are not even necessarily that interested in investing in it, and so keeping control of a company like that is a very different thing. It can be an awesome lifestyle business, it can be great for you. You might want to maintain control for a variety of reasons, but when you get investors involved, they want something that can scale very large, and so often you're going to be forced to make those kind of decisions around, hey, if I maintain control, I may not be able to grow this as big as it could be if I'm willing to give up some and bring in some growth capital.
Right.
Yeah.
I'm not afraid about giving it up. I don't know very much about investing in how this works and some of those concerns.
Yeah.
Good question.
Great question.
I would also just like to add that, I think that entrepreneurs would be benefited by being much more strategic, much more thoughtful about the investors they bring. I mean, these guys have alluded to this today, that you need to be really thoughtful about who you bring on, because the right investor can actually really help accelerate everything that you do. If they have invested in your industry consistently, they have a lot of network, a good network, a lot of contacts that can really help you in terms of client introductions, recruiting, partner introductions. That could be so valuable to what you're doing. Can also give you a stamp of credibility and actually brand your business. I mean, Y Combinator, that's all he has to say. And now I understand why he had 50 investor conversations, is because they were all beating his door down, because he had Y Combinator, right? So, but that was a brand for him, right? And those kind of things, having like an NEA. I have a friend who raised a seed round at an awesome valuation from NEA. They didn't even ask for a board seat. They're like, yeah, here's $1 million, go build this thing. He had like no revenue. He literally had like a template that was on PowerPoint, right, for his prototype, his idea. They're like, here's $1 million, we don't even need a board seat, go build it and, come talk to us in 12 months. And NEA, right, it's awesome, right? And they're perfect. They're in that industry. So you be strategic and approach the right people who know your industry, know your game, and can actually help you accelerate your efforts.
Brandon, your first investor didn't take a board seat, and I think he was actually against it, right?
Yeah, so we did a Series A earlier this year, and if anybody's familiar, it's the guy that led the round. His name's Ronnie Conway, son of Ron Conway and SV Angel. But I don't know why it's very contrary to what everybody else believes.
That's because they do so many deals they can't actually sit on them.
Well, that's SV Angel. Yeah. We were Ronnie Conway's very first investment in his fund. Andreessen Horowitz stopped doing seed investing, and Ronnie was running the seed investing for them.
Very cool.
So,
but I can add for our round what we raised from Draper Associates, which is Tim Draper's personal money. They also didn't take a board seat, interestingly.
Yeah, our deals didn't either.
And so maybe it's a little bit of an emerging trend.
I think it is
starting in the Bay, which is kind of cool. He said, go build this. I don't want you spending time preparing board presentations for me for the week before the board meeting. I'd rather you out being on the road selling. So I found that really refreshing and extremely cool. I loved it. So.
Yeah, I get a lot more value out of talking to my board members on the phone
Me
than
too.
I do about than I go to board meetings.
A lot.
Yeah.
Just driving home from work, I'll just say,
Yeah.
those are great conversations.
Yeah. Okay, we'll take one more question. Go ahead.
Do you have any hints or tips for a company when they're trying to go for their basically first round when you're pre-money? For us, for example, we're building hardware and we've got a lot of personal money involved, and we've built it to the point where we have prototypes ready to go, but to take it to the next round, we actually have to run it to production. We've got to build up sales. How do you attack that when you don't have any revenue?
Kickstarter. If it's hardware, you're going to need to get some sort of proof that you're going to get traction with it.
It's not consumer electronics facing.
Is there any way to get some level of proof?
Yeah, I mean, has anyone here watched the lean startup videos? They're like totally free online. I mean, doing that customer research process should actually generate a lot of validation that you should slap on a page on your deck that says,
We have a lot of validation. We're in the ed tech space. We won awards from ed tech things just based off of the prototype.
there you go. That's good enough, man.
That's good.
Yeah.
That's pretty good. There you go. Okay, let's give the panel a round of applause and close it up.